Good day, fellow investors. Brookfield is the only stock you will need for the rest of your life. And that is also confirmed by Bill Ackman making Brookfield Corporation the top position of his portfolio. And I actually think that is a mistake because he should invest all his money into Brookfield and close down shop because of the great situation that we have now with Brookfield stock. And let's immediately look at what they are doing. They invest in good businesses. They run those businesses well. They allocate the excess free cash flow wisely, align everyone with long-term objectives, and then also look at renewables and how that is invested. The results are staggering, and the stock has been nothing but compounding over the last years. And despite this jump here of 40%, Bill Ackman bought here somewhere, and despite the fact that the stock is up now, there is still a huge opportunity here of 20% yearly returns. They have their own perpetual capital, they have insurance float, and they are an asset management with 1 trillion assets under management that gives you the power to invest. And over the last 30 years, they have done an amazing job returning 80% annualized returns, but the best should just be ahead, and they are now positioned to deliver 15% returns over the long term, and they are better positioned than ever before. But that's not all. Interest rates are going down as the Fed is lowering. That will lead to higher asset values, lower capitalization rates given lower interest rates. That should increase the returns of capital to investors. And there is also increased transaction activity, more opportunities, more carried interest generation. And they have benefited from lowering interest rates in the past. That's why the compounding. This blip, and now as the Fed reaches again lower interest rates, the assets here, and you can see the stock already preparing, but this is still very cheap compared to the cash flows that will grow 20% annually. They will generate 47 billion of cash flows or $30 per share in the next few years. And that should then lead to growth of the planned value per share from $84 to $176 by 2029. That's more than a double in 5 years. So where can you find a better investment than this? Plus, on top of it, the planned value per share now is 84. The stock price is just 56. So first we need to go to 84 and then to 176. And that should compound your returns at 29% per year. 29% Bill Ackman is investing. Thus, this is an insane opportunity that we are looking for. They just need to keep on doing what they have been doing for the past 30 years, which is a great confirmation of things. The stock will just go up 29% per year. I don't know what else do you expect. There is one mention of risks in their 100-slide presentation. We are well positioned to deliver 50% returns over the long term while taking moderate risks. So the risks are not crazy, just moderate, and therefore you should expect earnings to grow at 20% annually to 9.77 per share. The stock price is now 56. When the earnings is implemented into valuation, this goes to 100, this goes to 200, and even more. For that is a 4x over the next years. Free cash flows, staggering, all great. They have asset management, huge capital, wealth solutions, fees, operating businesses, nothing wrong there. If you look at the public holdings, most is private equity, private holdings. Everyone is saying go into private. That's where the money is made, and they will achieve great returns, huge continuous growth there as they just keep on doing what they're doing with a very low debt to planned value ratio. So if you look at these numbers and how these numbers will grow, distributable earnings growing, everything will grow. So there is nothing to be scared of. 56 to minimum 100, that's a 3x in 5 years. And the key takeaways are that the tailwinds are there, lower taxes, more investment, better economy, lower interest rates. They know how to do that. 20% annually, conservative balance sheet, 50% of returns, and they are continuing to acquire things. Bill Ackman is invested, and I have to change my value investment quadrant. It doesn't fit here. This is 30% per year with moderate market risks. This is better than everything else we have discussed. Bill Ackman should close down shop, sell all the other assets, put everything into Brookfield, and make a service to his investors. I will stop talking about investments, put all my money in Brookfield, and go back to teaching accounting. What's the difference between IFRS and GAAP principles, how that works. Go back to teaching, forget about everything, put all your money in Brookfield, have a nice life, enjoy life, 30% per year. What do you want more? Put your money there and watch paint dry. Are you still there? I told you to put all your money in Brookfield, 30% per year, a 4x in 5 years. What else do you want? Maybe you don't want to watch paint dry? Then go play golf. You're still here, huh? Why? Didn't you put all your money in Brookfield? 4x. What else do you want? You want the risk side of the equation. Well, they say it's just moderate risk, but let's look into the numbers and discuss the risks. The total assets, 500 billion, common equity, 42 billion. That's 13 times equity, 13 times leverage, 13 times. And let me just show you something here. If we look at their valuations, they have their private holdings. This is valued almost at 30 times earnings, 90 billion. The other things are 15, what is that? 20. So pretty expensive, 15 times, 30 times, so between 15 and 20 times earnings. Alright, that's what they value their own assets. I have looked at the balance sheet. We have equity, investments, property, intangibles, and goodwill for a total asset value of 413 billion, the total equity 170 billion. Alright, we have seen how they are valuing that. If I just change the 15 to 30 times earnings, let's say 20 times, 25 times earnings, or 30, if I just lower that to 15 times earnings, goodwill goes to zero, intangibles go to zero, that's impaired. 15 times earnings, what's left from 30 times gets cut in half. The remaining value is 170 billion. We have lost 170 billion, equity is gone, intangibles are gone, the equity is then minus 60 billion. That's the moderate risk they are talking about. Zero equity, negative equity. Of course, it's all a game of valuation and interest rates. It is a possible risk that interest rates go higher, you lose all your money by investing in this. That's the name of the game. As long as the financial situation and environment is loose, they can borrow money, they can play around with interest rates, the stock will keep going up. That's a given. I look a little bit of cash flows. The cash flows are not staggering, but I have to look at this. They need to borrow a lot. Non-recourse borrowing new for 80 billion. So they need to constantly borrow, borrow, and borrow. And of course, this is non-recourse debt. So if that asset goes bankrupt, the company is not liability. Yes, the value of the asset will go down. And if you have zero equity, nobody will give you any deals anymore. But as long as this is continuing, the Fed lower rates, they will do well. They will be able to borrow and keep playing the game, keep valuing their things. But going on value, how are they valuing things? Valuation method, fair value under IFRS, fair value under IFRS, fair value under IFRS. What's the key factor here? What's the difference between fair value of generally accepted accounting principles and IFRS? US GAAP requires that fixed assets are measured at their initial costs. Their value can decrease via depreciation and impairments, but cannot increase. Okay? IFRS allows companies to elect fair value treatment on fixed assets, meaning their reported value can increase or decrease as their fair value changes, thanks to Wall Street prep. Let me show you another thing. This is IFRS world, the blue, and this is GAAP world. So this company is not incorporated in the United States, it's incorporated in Canada. And from Canada, they acquire their things, put them private, and then they say what's the value of those things privately. They have just acquired Neoen, the French renewable company there, for 6 billion. So great deal for the French. Everybody was happy. They were drinking champagne in French, getting drunk, doing hanky-panky. But okay, those are the French partying. But if I look at the balance sheet, they paid 6 billion for 5 billion in assets, tangible fixed assets, okay? There is EBITDA, 10, 12 times EBITDA, okay? They also paid 10 times revenues, 8 times revenues. Okay, that's normal for renewables. However, there is also 3.5 billion in debt. The gearing ratio is there significant. We said, what was it? 5.4 billion in assets, let's say 5.5, 3.4 billion in debt. So the actual tangible value is 2 billion. Brookfield paid 6 for 2 billion of valuable assets. So they are levering on something that's already leveraged to the hilt. So leverage, top of leverage, doesn't it remind you of, I don't know, the financial crisis of the 2000s? Nah. I'm looking at net income, okay, 150, 160, let's say 200 million, 6 billion. Yes, that's their 30 times earnings, and they will just keep doing that. They are pursuing the transaction through the Brookfield Global Transition Fund, their flagship vehicle. So transition to net zero economy. They have already spent 25 billion euros in France. The French are happy and drinking champagne, people. But I think that Neoen in reality is worth 2 billion euros, not 6. And that would completely change their balance sheet. But as long as this debt pile in the world of $150 trillion keeps on piling, no fear for companies like Brookfield. Because if that debt, like financial markets, freeze here and there because of panic, asset valuations get revalued, then this happens. Babcock and Brown, again, not a US company because you can't do these things from the US, listed in Australia. They were just doing that. Brookfield bought some of their bankrupt assets. The stock exploded from 7 to 34 on the same party going on, acquiring assets, railways, whatever. Then when the market froze, it went quickly to 0. That's the risk and reward. And ask yourself also one question. Who has capital? Who has money? Who could buy up everything, lever to the hilt? Berkshire. Why isn't Warren Buffett doing the same at Brookfield? He has better reputation, better everything. He could buy those assets, make a lot of money for eternity, without worrying about borrowing about anything. Why isn't he doing it? Well, the risk is the answer to that question. As long as the growth is there and the money is there, Brookfield will continue to grow. Everyone is happy to sell to Brookfield. Yay, partying. They do not provide an advantage. They just pile on that, play on that valuation spread game. It's just a game of capital as long as they have it. They need eternal growth. If not, the party stops and it looks ugly. Why did Bill Ackman then buy? I think he's nervous. He's going into politics. 2 years ago, when he was doing great, he was the Zen master of investing. Now I sense nervousness with him. He has been underperforming the market. He looks at stocks just going up. He missed the boat big here on Netflix by buying and then selling 400%. He's getting nervous. His investors are getting nervous, and he's just tracing the trend. That's the story. Thanks for watching till here. We'll keep just doing what we do here, and that's value investing.